Welcome everybody to the Advisor Strategy Room. I'm here with Travis. Travis, how you doing?
Good, Brett. How are you?
Doing good, thanks. Super excited. We've got a special guest with us on this episode, Jeff Nash. He is the CEO and co-founder of Bridgemark Strategies. So Jeff is the leader of our group here, and he has been in the business for well over 30 years and 25 years of experience recruiting and consulting financial advisors. He's a recognized industry thought leader and has been published or quoted in industry media and has been asked to speak at several industry conferences. So we're excited to have him exclusively for this conversation to talk about advisor M&A. Really dig into, I think it's a hot topic out there. We're getting more and more conversations, more and more questions about valuations, who these buyers are, what the differences is. I think it's definitely evolved from even 5, 10 plus years ago. So excited to have Jeff on here to drill him with some questions to help share with our audience some of the mystery that's out there. So welcome, Jeff.
Thanks for having me, guys. Quite the intro.
Jeff, let's kick things off. Obviously, as I said, M&A seems to be everywhere right now, whether it's firm M&A, but more importantly for this conversation, advisor M&A, and the world has changed. Why do you think it's become such a hot topic with advisors?
So it's become such a hot topic because the valuations for businesses have gone through the roof. And by the way, it's not just true of our industry, right? We've seen other industries where private equity has gotten into the industry. Literally, for those who may or may not know, HVAC, right? The heating, vent, AC folks, the private equity's gotten into that business line and has exploded their valuations as well. But what's happened here is as private equity has gotten into the business, it's repricing everything from M&A to even just regular recruiting. Every advisor and the profitability of that advisor is being looked at with a very different lens. And that's what's driving so much activity here. I would say one of the big eye-opening to this whole thing is there's still an amazing amount of advisors who actually have no idea what's happened to the value of their business. Again, almost similar to the HVAC. There's a lot of local HVAC folks that are out there in the marketplace who have no idea that their business is worth life-changing money. And that's true for financial advisors. We look at financial advisor businesses. When I started, maybe you were lucky if you got 2 times revenue. And when that was if it was all fee-based and you could find the right buyer because buyers were selective. I can't tell you how many conversations with buyers in those early days that I've had said, yeah, I love to buy a practice, but it's got to be perfect, where I don't have to work too hard and I don't have to pay too much. And then the clients all come and just keep paying me more money. And that's what the buyer would say. And now we're looking at deals that are literally they're multiples of EBITDA that go 10, 12, 15 plus times EBITDA. Just got an indication of interest on a $700 million firm, literally earlier today on a 15 times EBITDA multiple. So the numbers keep getting higher, right? This translates to 6, 7 times revenue is what these numbers can translate to. It's really life-changing money for folks.
That's unbelievable. Could you maybe touch a little bit on what sort of factors are driving those high valuations? Like, what does an advisor's practice, an ideal practice look like to warrant such a high multiple?
Yeah, and that is the multi-million dollar question. It really is, because they're not all worth that, right? That's for the right business. And so we've actually written a white paper on this where folks can go to our website, Bridgemark Strategies, to download it, to learn a little bit more about it. But this is the conversation that you really have to understand. This is the topic that you really have to understand. And if you're looking into the future, 3, 5, even 10 years into the future, building something, if you don't have that much time, there's still opportunities in here. And when you think about how do you maximize the value of your business, we try to keep it really simple. And we really keeping it 5 things that are really important to maximizing the value of your business. And those 5 things, I actually created a little play on words and turned it into an acronym of the 5 things that drive price. So it's the 5 letters of the word price are the 5 things that drive it. And the first one and most important is people, right? Having a team of folks, a team approach to the business where the clients are serviced by the entire team. There's not an individual silo approach. It's an ensemble business. There's multi-aged advisors, there's support people. A team approach to the business, having the right people can absolutely drive price. The R is for revenue, and revenue really comes to all different types of revenue, right? Is it fee-based versus commission-based? Is it reoccurring fee-based? How are you managing the individual portfolios? And so when we think about the R, our revenue is a big driver. If you have a fee-based business that does financial planning, you're going to warrant high valuations. If you're a more commission-based business or more transactional-based business, the valuations are going to fall through the floor. I stands for increase year over year, which is growth rate, right? What we're seeing, and it's happening more and more, where I had it happen just the other day. Buyer, very engaged with a seller, and looks at some of the numbers and said, you know what, we literally have changed firm-wide, and sellers that haven't achieved a historical growth rate that particular buyer was looking for, they're no longer even going to entertain it. And so growth rate is really important. Growth rate is measured primarily by net new assets. So a lot of advisors look at growth on revenue, they look at growth of their income, they look at growth of clients. Heavily based on net new assets is what we want to look at for growth. Second to last is C, clients, right? That's an area where the buyers are really wanting to see what's the client makeup. Are they really old? Are they really young? Are they barbelled based on the size of the deal? So are we seeing a couple of really high, ultra high net worth clients and some lower end clients? What is the makeup of the book? Because there are definitely buyers out there that have minimums that they want to make sure it's a good fit between the buyer and the seller, so the clients are properly serviced. And then the last piece of this is super important, which is EBITDA. That's the letter E for EBITDA. And EBITDA is how deals are priced. So a lot of people will think about revenue, multiples on revenue. A lot of people will think about even multiples on owners' compensation. So there's another expression we call earnings before owner's comp, or EBOC. But ultimately, the buyers are pricing a deal on EBITDA. What is the free cash flow of the business after the advisor selling the business is even being paid, right? So understanding how to determine EBITDA is one of the most important criteria when you're looking at this business. And really it is, what is the free cash flow? What is the pure profit after you pay all your expenses, even paying yourself a salary to service the clients? And that salary is somewhat more determinant on the buyer versus what the seller may say they want to pay themselves. And that's what's left over is EBITDA, and that's how we see deals priced. So real long-winded answer, Travis, I apologize for that, but it's a lot of, there's 5 different components to this. And each of those components can be equally important. And you want to understand that, right? So the final piece to this whole thing is, what can you influence? And you can influence a lot of it, right? You can certainly build out your team. You can make sure you're approaching the business from a financial planning perspective versus just assets under management and managing portfolios. Those are big drivers of revenue, right? You can try to impact growth rate, right? That's a little bit harder, but you can try to impact growth rate, put a program into place to generate more referrals, be conscientious of how you're doing that. If you have a lot of older clients, try to figure out how to bring in those clients' kids into the business. Even if they don't have the assets, you're still lowering the overall age of the client base. And by bringing in the kids, as we all know, those become the beneficiaries, which also become really good accounts. And all of that can feed into EBITDA, right? Just overall profitability of running a smart, profitable business.
Yeah, that's great. Is there anything that advisors are doing today, probably unknowingly, that's reducing the value of their practice? Have you come across any situations, or could you maybe give some, hey, you might not know that you're actually doing this and it's hurting the value of your practice?
Yeah, so there's a couple things in there. One of the problems that you see is when you go to advisors trying to manage individual client portfolios individually, right? Again, when you're going to a buyer, the buyer's building model portfolios. The buyer wants a financial advisor who does financial planning and is helping clients achieve their life's goals. And they don't really need someone who's a portfolio manager. And so for that financial advisor who looks at themselves more as a portfolio manager, can be hurting their valuation, right? Because they're going to move that business into the buyer's model portfolios largely. And there's some level of customization. So it's not that the clients aren't being taken care of, it's that the buyers, and they understand the greatest value of a client, the most stickiness of a client, which is what drives the value of the client, that comes from financial planning. When the client is engaged in financial planning, they're not asking as many questions about performance returns. And that's how you keep a client much longer term. And that's what the buyers know. So you have to remember, in this business, the buyers themselves are heavily private equity backed. I think I heard the number, it's the 48 of the top 50 RIA buyers are all PE backed. And so when you look at that number, the one thing you could say about PE, there's a lot of people who don't like PE, but the one thing you could say about PE is they are very intelligent and they're smart in what they do and they know the numbers. And so when they're looking at being a buyer, a strategic buyer, they want to know if the seller that they're buying their book of business, what's it based on? And for those folks that overweight on performance returns, has a more fluid client base that can come and go versus those that are on financial planning. So that's one. It's a long-winded answer again, but I think the other important element in here is advisors who actually don't even understand what they have. So I was talking about a client just the other day that I just met with, just got an offer. The offer came in at $50+ million. And to the advisor's credit, he's working with me, hired us to help him evaluate the marketplace. But he had gotten an offer for $43 million that he thought was amazing. And without even working hard, the first offer we got is over 50. So not understanding what you actually have is what really goes against you. And that's even more true for the W-2 advisors, right? We think about this in the succession world where they just sell their business. They're getting 2.5 times revenue at ordinary income. The junior advisor gets trapped at the firm. The senior advisor is getting a below market rate. And it really is not understanding the value of your business can really hurt you as well.
Yeah, Jeff, I think you kind of touch on a great point here. And I know all of us talk about this together and the difference between getting a professional valuation on your practice and testing the marketplace, right? Obviously advisors, there's several quality firms out there that will come in, or even maybe the IBD or the firm that you're with will do a valuation and tell you what your practice is worth or what they think it's worth. But ultimately, it's what is somebody willing to pay for it, right? And going out, and we work with a lot of advisors where we take their business, we collect some information, and we take it to potential buyers. And then how does that seller fit with the buyer's model? And so therefore, how attractive is it to the individual buyers? And some are willing to pay more and some maybe price themselves out of it because it's not attractive to them. But we really test to see what the market's willing to pay for a business versus just a appraisal.
Yeah. So what in the marketplace, right? If we use real estate, because everyone's pretty familiar with what happens in the real estate world. And in real estate, you can get an appraisal on your house. You can get a tax value on your house. And then you can get a market estimate on your house, right? And what we see out of certainly appraisals and tax values is those aren't necessarily indicative of what you actually could sell the house for. Sometimes they're higher, sometimes they're lower, but they're directionally accurate, but they don't tell you what you're really worth, right? And so I don't think anyone would sell their house on an appraisal, would trust that. They wouldn't, and they certainly wouldn't sell it on a tax value, right? So that's what we see out of that. And again, sometimes those appraisals can come in higher, and some people may say, yeah, I've had great luck with appraisals. But the reality is the marketplace, especially in a rising market, which is what we've seen, right? What we know about, again, in real estate is those rising markets in real estate, what we've seen out of them is the appraisals are usually behind the marketplace, right? You list the house, you get 3 offers above asking on the first day. We're in that market here, and we've been here for certainly over 5 years, and we're probably going to be here for another 5 years. Not that I can predict the future, but the trend line is such that this market is a hot market for sellers. And it's starting to bifurcate a little bit. So sellers need to be honest with themselves, because what we're starting to see in the bifurcation is, if we think about it from a tiering, there's those sellers that would be an A quality, and then you could say a B quality and a C quality. And we're seeing those A quality sellers being very attractive to the A quality buyers and getting incredibly priced. With the B's and the C's, it's getting more competitive, and we're certainly seeing some of those A quality buyers walk away. And so the marketplace is really, to really understand the value of your business, you really have to talk to someone like us to understand the value of your business and what the marketplace is. More than, in fact, I would say on numerous occasions, I've had clients whose businesses we've sold, and we've sold those businesses for not 10 or 20% more than the valuation, because they've received valuations for more than 2 times the valuation, right? In simple terms, if the valuation came in at 10 million, we literally sold it for $20 million. So we've had stories like that where we've sold businesses that much more than what valuations have come in at. from independent recognized valuation companies that are specializing in this industry. But the market has just been, some of it's our curation, some of it's finding the right partner, which is what we do, right? It's a big part about curating and finding the right partner, but it's worked out really well for both buyer and seller in those scenarios.
Yeah. Maybe to touch on the types of buyers and firms, we hear a lot about different ones, but when we break them down, there's integrators, there's aggregators, there's roll-ups. And I think that can be very confusing, especially to advisors and sellers. Is this an integrator? Is this an aggregator? What is the difference? Or are they all the same thing? So maybe if you could just give us the high level bullet points on what the difference is between these three different potential
it
buyers.
starts with just the individuals, right? And so you have individual buyers. And what's an individual buyer? Someone who's doing some level of production, who's buying their friend, their stranger, someone who lives in the town, and it's peer 1v1, right? It's peer versus peer, and they're buying their business. So you have that, which can happen. And then you start to get into the institutional buyers, right? So then you've got 1v1. Then you have a little bit bigger 1v1, right? So you have somebody else who's in town, but they've maybe done a couple of other acquisitions, and they've got a little more experience, a little more scale, and they're now looking to buy, right? So now, the thing about each of these structures is there are really clear pros and cons with each of these structures. And maybe we'll have time on this. If not, this is one of those things that you have to really dig into to kind of understand that. But there's some real negatives and positives in each of these individual structures, right? So then you go for more of it's a smaller group who's been having some success buying. From there, you can get into the institutional buyers. And the institutional buyers, they fall into all kinds of different categories. And the problems with all these different categories is first of all, there's no standardized labeling on these categories. Second of all, is the firms inside of these categories will also cross over. And there's more than a handful of firms that we work with that will literally structure a deal in A, B, and C, right? So we have what Brett talks about with aggregators. We have integrators. We have roll-ups. We have partial acquisitions, right? These are all different types of ways that you can sell in. And with each of these, you get all cash, you get equity, you get some equity, some cash, you get all equity, right? What's this? Is there a drag along, tag along in some of these stuff? So I'm throwing this out fairly rapidly on purpose at this point in the conversation. But the most important piece here that the challenge is a firm will do 2 or 3 or 4 different types of structures. And so then how do you even compare apples to apples? And again, to kind of high level explain some of this stuff, what we see in the marketplace is integrating firms or integrators are often called aggregators, to be clear, because they're acquiring advisors, but we think of them as integrators. And an integrator is then going to have common brand, common portfolio management, right? Centralized, there's going to be some element of centralized infrastructure. And that's what we see with integrators. With aggregators, you are really tend to continue to run your business as you've always run your business, as a standalone. So you've sold it, but you're standing it alone on its own merits. It's just now the ownership of the business will be an institutional investor. Then we have partial acquisitions, and there could be both there's typically not partials for integrators, there's more partials for aggregators. But with partial acquisitions, it's just that. Do you not want to sell the whole business? Do you want to sell a piece of the business? Do you want to sell part of it to your second generation? But they can't afford the entire business. And so when that's the case, a partial can be a really good strategy because the value of the business is so great, but you want to reward and incent the next generation that you already have. Another category is these roll-ups that we see. And these roll-ups are typically you sell a percentage of the business, and then there's an opportunity for a future liquidity event, right? So you roll up into a larger organization with a future liquidity event and are able to capture a much larger market share because you now are not just the size of your business, you could be the size of a multi-billion-dollar firm that has a much higher multiple that you're able to capture. And that's the roll-ups. So a lot of different types of structure. Again, a lot of pros and cons on these different structures. And what's right for any one person really comes back to what are their goals.
So for an advisor, would you, instead of trying to figure out, should I look at aggregators or integrators or roll-ups or this, it's really about defining what they want to accomplish. And then ideally working with folks like ourselves that will then help them find the solution that fits what they want. Don't have it dictated to you and go to somebody who's saying, this is what we do and push it on you. That's where it's figuring out your non-negotiables and what you want to accomplish by doing something, and then figuring out who can do that and not be worried about if it's an integrator, aggregator role.
Yeah, and maybe I'll give a little bit of a plug.
Would you
here
agree
for
with that?
Bridgemark. It is a Bridgemark podcast for all intents and purposes. But the reality is, it's my understanding that I think we are the only firm in the industry that is doing both recruiting and M&A at scale. What I know to be the case is comparing us to our M&A competitors, we absolutely are doing more recruiting than they are. And comparing us to our recruiting competitors, I'm fairly certain we're also doing more M&A than they are. So that puts us in a real unique space. And what it allows, and the reason that's a benefit is, to your question, Brett, to your point, is when we talk to an advisor, we're not predisposed on a solution or a path, right? We're trying to help them understand what their goals are, what they're trying to solve for, and whether that could be breaking away to an independent broker-dealer, switching firms, selling their business, setting up an RIA on their own, whatever the solution is. And we've had more than a few, right? I've done several M&A transactions that have actually started with, hey, I think I want to set up my own independent RIA. And we have a lot of conversations and make introductions, in fact, along the lines of establishing their own RIA. But we also dig into what are they really solving for. And I say, trust me, let's look at a couple of these other things. And of course they do. And we look at these other things. And the next thing you know is they found a strategic partner and they're sold their business. Or I should say merged their business, right? But that's not uncommon for us. And so to what you were bringing up, when advisors come to us and have a solution in mind, it's usually the first thing we try to do is get them to forget about the solution and to understand what it is they're trying to solve for and how they came up with that particular solution, right? And so that's what we're trying to really determine is the right path for them. And with all of our collective years of experience, with all of the deals we've done, with our knowledge of the marketplace, we're curating solutions that very well could be, if we use an expression, shades of gray. It could be 3 different shades of gray, but it could be 3 entirely different colors as well. And we're not even sure which direction we're going to go in. And that's happened more than a few times.
Yeah.
Jeff, I want to go back to something that you had touched on, the structure of the deal, and specifically the equity portion of the deal. It seems even in the recruiting world, we started to see firms start offering equity in the firm, right? So when you hear that word, and even some headlines were recently that are negative around equity in a firm. So when an advisor hears they're being offered equity, what exactly are they being offered? And maybe more importantly, how is that equity
It's
valued?
a great question. And the answer is you honestly sometimes have no idea, right? That's the truthful answer. What we see in most M&A scenarios is the buyers themselves have a very clear formula for how to value their equity. And I say most because it's not across the board, but it's certainly the ones we've done. And that methodology is quite simple. The last time they transacted with a private equity firm was at X multiple. Today, their revenue is X, their expenses are Y, their profit is Z, right? They have debt service as another line item in there. And so they can actually, using the exact same formula on modernized numbers or updated numbers, determine what the value of that business is, multiply it by the number of shares outstanding, and then you have a stock price. So it's very easy to really understand that. What we've also seen in the marketplace is firms have raised capital, and they've raised capital on even some future valuations. And so those future valuations are, hey, we've raised capital and our future valuation is we're going to grow to this point in time, but we're going to set our stock price at X. And we're going to give it to the advisors. And if we grow above X, then there's value. So a lot of times in the equity world, the value of that equity may never be achieved, or it may take years to achieve. Because in some cases, what we've seen is you actually have equity valued on a future price, and then you're getting a growth rate above that. So you've got price today down here, equity priced here, your success and opportunity for success is up here. And the company has to grow through that for you to generate success. Look, there's just a lot of different formulas in there. A lot of people think equity is the windfall. And if you're starting a firm and you can grow that firm to 10, 15, 20, 50 billion dollars, and you've done that, and you're part of that original cap table, you're going to be very successful. If you're selling your firm into a easily determinable, you can certainly think that equity is going to continue to grow. Certainly I do, right? For a lot of these firms, I think there's going to be a lot of opportunity for growth. But for just being a recruit and joining a firm and being given equity, and you're not actually sure how that equity is priced and what is determined and what is based on, I wouldn't join a firm just because of that, right? What you have to remember in that example is the equity sounds great and it's a great kicker, but the most important thing is the asset that you actually have is your asset. It's the value of your business. That's the piece that we've been talking about with M&A, is the value of your business is more than you could ever know, and focusing on growing that with the right platform is going to be way more rewarding than having somebody else potentially giving you phantom equity.
Jeff, how transparent are firms offer an equity? How transparent are they in how they're valuing their equity, like coming up with the valuation or what it's worth and all that? Is it pretty
It's all over
pretty
the map.
easy to obtain,
It's all over the map.
or is there?
It's not. You can't paint
Yeah.
that one with a broad brush. It's really all over the map.
And I think advisors
Well, there's
hear
a lot of
equity
people making a
and
lot
they
of
get,
money.
you know,
Like I said, but
intrigued.
the biggest
But
piece of
to
this
your
whole thing
point-
is the value of your business, right? Do the
Yeah.
things that you don't hurt the value of your business by joining a firm where you think there's going to be an equity play, right? Look, I've been in this business a long time. I've invested in stocks myself for a long time as well. And I remember when I was young in my 20s, investing in stocks and buying something because it was quote unquote a takeover target, and watching my money get devalued because it never got taken over, right? So you'd lose sight of the bigger picture, right? You buy a stock, we all know this, right? You buy a stock because you like the fundamentals, whatever the reasons you buy a stock, right? The business itself has real value. Don't join a firm for the equity. That could be the icing on the cake. It could be the dividing line between two finalists, but you don't join a firm, right? The piece to this whole thing that you have to talk about is feel, fit, and financials, right? It's an expression that we've come up with, an expression we've trademarked, an expression we coach advisors on how to find the right firm. And feel is about culture and philosophy. It's about the big picture, the business. And fit is the business itself. It's the tools, the technology, the products, the things that you need to manage clients. And then there's financials. And the sequencing of those is really how to make the right decision using feel and culture first, philosophy first, the objectives that you're trying to solve for first, then making sure there's no deal breakers in the fit, right? Making sure that they can support your business, and then look at the financials. All too often, and Brett, you've been doing this almost as long as I've been doing this, we've seen hundreds of deals where advisors have regretted those deals. This is, again, 25 plus year career of doing this here on my own since 2014, but hundreds and hundreds of scenarios where advisors have been regretting that they made a decision. And if you peel it back, they always made the decision for economic reasons first and foremost.
Yeah, Jeff, could you maybe give a couple specific examples, a situation where you've seen a deal with an equity portion to it go right, and one where maybe you've seen it go wrong?
So I'll give an example of something where it went right. It's hard to give specifics because we've got confidentiality in all of our deals. So I can't list firm names or anything along those lines. But there's a firm that I know that we've done work with, and I've known this firm for literally 20 years. And one of their first acquisitions, it's my understanding that the value of his equity, and this is probably 10, 15 years ago or something like that when they did their first acquisition, the value of his equity is literally 50-fold. And there have been several liquidity events, so he's been able to monetize if he wanted to get cash out of it. He could roll it, whatever he's done. I don't even know what he's done. But the value has gone up literally 50-fold in the value of his equity. I'd say that's a pretty good success rate. And with liquidity events, so not just on paper pricing, hey, you want to take some off the table, there's been multiple opportunities to do so.
Yeah. Jeff, one of the things you mentioned earlier, and there was a string there where you mentioned dropped a couple of nuggets. One of them, and I think we're hearing advisors start to ask about it, is what is this drag along and tag along rights? I think it complicates an already complicated conversation, but maybe just give us some bullet points or talking points around what are drag along rights and what are tag.
So what in
rights, and
drag
how should
along, tag
advisors
along?
be
It's
looking
typically
at
with
that?
a minority interest. It is an advisor sells or finances and sells 5% to their junior advisor, 10% to their junior advisor. And when that's the case, if it's done properly, then the junior advisor will have a drag along contract, which means if the senior advisor chooses to sell, the junior advisor will be dragged along and will have to join in at that price. Okay. A tag along is then more of a voluntary where the junior advisor says, I want to tag along, right? I want to come along with it. What we see in some of these institutional deals is a minority sale, and the minority sale may have a component of both a drag along and a tag along. And so you sell mathematically 10% of the business. And that 10% then has a drag along where if the primary gets a liquidity event, they may say you have to sell another 20% into our liquidity event. That would be a drag along. So now you've sold 30% of the business. And they may give you a tag along, right? That's a drag along. And they may give you a tag along that says, hey, I actually want to sell even more because of the price, and I want to sell 50% of the business. And so that's how the drag along and tag alongs work. The real watch out isn't so much anything in the drag along, tag alongs. That's really more of just how does it work in the marketplace? And there's no real pros and cons on that. It's just more matter of fact. The real cautionary watch out is when you sell a minority portion of your business, what are you getting for that sell? How is it structured and what are you getting? What we have seen is we've seen advisors selling a minority of their business for 3, 4, and even 5 times revenue. I've started to see numbers tricking up to even 6 and 7 times revenue. And I think most people would listen to this and say, boy, if I could sell 20% of my business for 7 times revenue, sign me up tomorrow. The problem with that, however, is when you're selling 20% of your business, you're selling what the industry calls free cash flow. You're just selling revenue with no expenses. And so you're selling a bigger portion of your free cash flow. Free cash flow is what you get after all your expenses. That's the EBITDA we were talking about earlier. And if you sold 20% of your revenue, you could be selling 50% of your EBITDA. What's the math on that? If your EBITDA is 40% out of the 100, so you've got expenses of 60%, including paying salaries of yourself, right? Then what's left over is 40%, and that's what you would sell your business for. And so selling 40% of that, selling half of that at a 7x revenue sounds great, but realistically, the entire amount could be worth 8 or 9 times revenue. 9 times EBITDA. And so it's not always the great formula to sell part of the business at a multiple on revenue unless you're getting something in return, right? What are you getting in return for that sale? And you really want to understand what that is and make sure it's valuable and reciprocal so that you can actually make that transaction worthwhile. It's complicated, a lot of numbers in there.
Awesome. Yeah. Definitely. A lot more topics that we could dive into. And we really appreciate you coming on today, Jeff. But before we let you go, we're going to put you on the spot a little bit. And we're going to do what we call the lightning round. Okay. So I'm going to ask you a question. And what we're looking for here is a one word or a short answer, which I know,
one of the
you and Brett might struggle with this a little bit, but here we go.
Go ahead.
Really?
Whatever. We'll see what the questions are.
Okay. So you might be prepared then, but here we go. You ready? Yeah.
Highest
multiple or best partner?
Or best partner related to M&A?
Yeah. These are all related to everything that we just talked about.
Yeah. Best partner.
Okay. Most
overrated deal metric. EBOC. Nobody really looks at EBOC.
Okay. And most underrated deal metric.
From the seller's perspective, they don't think enough about net new assets, where the buyers are really honing in on net new assets. Sellers are often thinking about revenue growth, client growth, even asset growth, which includes markets. Buyers are really honed in on net new assets.
Okay. And I'm putting this one on a T for you. What's one thing every advisor should do before considering a transaction?
Yeah.
Slam dunk. Okay.
Yeah, there you go.
All right. Last one.
Call
here.
us.
Last one here. Who's going to win the U.S. Open?
Hard to pick again. So yeah, I don't know. I'll probably stick with Scotty. He's trying to get the Grand Slam, and so he's going to be laser focused on this one. So it's harder to get against him.
And it's his birthday on Sunday, and it's Father's Day on Sunday. So I like that. I like that pick. Absolutely.
Jeff, hey, this has been awesome. Tons of information. I'm sure we'll be knocking on your door to have you come back on a future episode and maybe talk more about the M&A topic or one of the other numerous topics I know you're well versed and can talk a ton about. So we really appreciate having you on. And
Yeah, it was great.
Thank
Thanks
you
for
for
having me,
sharing all
guys.
this
It's
great
been
information
fun.
with our audience.
Thanks, Jeff.
All right. Travis, good
Brett,
to see
we'll
you again.
next time. Good to see you as
Absolutely.
always. Take care.
Take care.